Welcome back to the Compassionate Capitalist Show. And today we're going to be all in on crowdfunding. Any of you folks that have listened to this podcast in the past or have plugged into any of my training, the startup that I'm doing with bringing more people into the whole purpose of the Compassionate Capitalist movement is to bring more people into the marketplace to want to invest in entrepreneurs. And the easiest way, because it's the emotional connection you have with your money to stroke a $10,000, $25,000, $50,000 check as a traditional angel is a lot. That's a big number, for people to invest in a deal, unless you're, putting $500,000 or $100,000 at play. So the easiest way for people to put their toe in the water and get started and start to develop those skills of how to discern what company over this company, how to find companies that you're passionate about. So you share their passion. That's that compassionate part of capitalism on the Compassionate Capitalist, and why we do this show is within Reg CF type of companies. You could do Reg A plus, if you wanted companies that are further along, but there's not as many platforms, not as easy to get involved as it is with crowdfunding Reg CF platforms. And we're going to, talk a little bit about the history of that. But I have today my guest, which is Jonny Price. For those that are watching, he's sitting here patiently waiting for me to do do his intro, but he leads the fundraising team at Wefunder, and Wefunder is, I'm going to give the full on bio here in just a minute, but Wefunder is the leading Reg CF platform in the United States, and I'll give you some of those stats. So having him, I met him through the Crowdfund 23, I think is what it was called. It was a virtual trade show conference for all things crowdfunding, and it was phenomenal. It was phenomenal. And I met Jonny through that. We had a chat a week or so ago. Very excited to have him on this program to educate you, the audience, more about crowdfunding, more about the benefits of it, the state of the industry, where we're going. So, quite frankly, the world changed in 2012. Prior to that, this has been part of my mantra, my story. It was angel investing or investing in entrepreneurs was, for all practical purposes, illegal up until 2012. For 90 years, when the Reg D offerings, the Securities Exchange Commission put out how private investors could invest in private companies without all the oversight of the government that does for public companies. And it really came down to this fundamental action of direct public offerings or general solicitation to investors. You had to have a prior relationship, you had to have a connection, and you had to be at a certain income level, what they call accredited investors, in order to participate in those. So that's like the simplest way to explain it. But with the Great Recession in 2009, 2010, the government started to get lobbying because they had seen reward-based crowdfunding have a profound impact on bringing innovation to the market, for really high-end things like we take for granted now, smartwatches, drones, 3D printers, VR headsets, all came to market with reward-based crowdfunding, which meant people gave them money and they got a product in advance. And it's still very viable for companies to get their minimal viable product to market using reward-based and not giving up equity. And certain high-end accredited investors and even venture capital really look to the platforms of reward-based crowdfunding. The most common names are Kickstarter, Indiegogo. And then now with Reg CF, and even the changes. It started out at $1 million, then it went to 5 million, and now the SEC offers up to be, you can raise up to $10 million on it. So they look at that as really proving out the business model, this whole thing, and probably even getting to a revenue point that they come in. It is a risk mitigation when companies go and raise money that way. And we'll get into some of the nuances of that. It is, and then there's some angel investors like in the Southeast where I am, where they go, ooh, crowdfunding. And it's like, they, don't know, it's the evil, whatever kind of a thing. I'm a big proponent of it. Obviously, Jonny Price is a big proponent of it. And we're going to get into all of that. But let me just give you sort of a level set of the state of the industry. Since 2016, and really, Reg CF was the last of the platforms that came out on the Jobs Act to have all the rules. So the Jobs Act was 2012. It was about 2015, I think, that the rules were finally established for Reg CF for equity-based crowdfunding. Regulation crowdfunding is where the CF comes from. So since 2016, private companies have raised $1.6 billion under Reg CF, providing access to capital for more than 5,000 small firms. At the same time, the Reg CF ecosystem has supported over 300,000 jobs while boosting access to capital for underserved communities. And there's doing so many different flavors. It's such an exciting industry. And that was the intent of the Jobs Act. It has succeeded. But here's the thing. We do not have enough people participating. It's about equal in 2022. It declined a little bit from 2021, the number of people that participated. But there's literally, it's in the hundreds of thousands. So 2022, it was like 300 and some odd, 500 and some odd in 2021. But there are 7 million people that could be investing this way. And when you look at it compared to Bitcoin and anything like that, a lot of numbers in Bitcoin, not this way. The emotional benefits of investing in an entrepreneur that's bringing something to market that you're passionate about, they're passionate about, putting your money to work because they're working really hard to do it, is profound. The financial and the emotional benefits, and to build a portfolio, the training I offer, are building your angel blueprint portfolio, that you can build a diversified portfolio that gives you income 90 days out through some of the lending platforms, or, long-term plays, that would be 5 years out. You can build a portfolio 3 times as profitable as your real estate and your stock market investment. It is, the statistics are there. So this is really, really strap in, listen up, because Jonny, with the biggest crowdfunding platform, is going to tell us the state of the union, best practices, some of the experiences that he has had, right? Because they have about 39% of the marketplace, 140,000 plus investors actively investing, putting in 2022 $172 million to work, right? Larger than any other Reg CF platform. And he says it's going to be even better this next year. So let me just tell you a little bit more specifically about Jonny, because when I got his bio, I realized one of the companies that he came from, I was very familiar with them and have referenced them in a lot of places. So they, again, it's a platform that helps founders raise capital from their community, allows anyone, not just the rich people, to invest in startups they love. Originally from the UK, you'll hear it in his accent, Jonny started his career in strategy consulting with Oliver Wyman before founding the US team of Kiva.org, which is does micro loans and puts investors' capital to work, providing really impactful debt financing in communities. His degree is in history from the University of Cambridge, served on the Federal Reserve's Board of Community Advisory Council. He is the proud dad of Felicity and Carlisle and Margot, and lives in Nashville with his wife, Allie. So officially, welcome to the show, Jonny. Great to have you
Thanks
here.
so much. Thanks so much. Great to be here.
So tell me what made you switch from connect some dots, right? Switch from Kiva over to Wefunder. What did you raise capital initially through Wefunder? Is that kind of one of the connections? How'd that happen?
Yeah, I was at Kiva for 7 years. I started the US team there in 2011 and ran that for 7 years. We made 5,000 loans to small businesses throughout America. Average loan was small, $5,000. So 25 million, but those loans were coming from maybe 200 people, lending $25 each or something like that. So it was kind of crowdfunding for small businesses. But there were a few problems with the Kiva model. Kiva was a nonprofit, and there wasn't really an earned revenue stream for Kiva. So we relied on people's donations, and that was great. And Kiva has helped millions of people around the world, but it was definitely a limitation on scale. And so that was kind of attractive to me. Wefunder being a for-profit business, we're a public benefit corporation, so definitely have an impact orientation to the business, a real kind of mission orientation. But it is a for-profit business. We charge a fee to entrepreneurs that are raising capital. That's how we make money. So that was attractive on the economic model for Wefunder. And then on the Kiva side, like, lenders don't get any rate of return. So they're lending at 0% interest. It's kind of philanthropically motivated. You're just doing it to help someone, help an entrepreneur. And there's no kind of hope of return. And what that meant was that the capital that we were able to raise and deploy to help founders was very limited. Again, there was millions of people that were generously doing this. But unless you offer a rate of return to those investors, the pools of capital you can raise are always going to be limited. So with Wefunder, as you've been saying, Karen, being able to offer investors a rate of return, so you can lend to your local brewery or coffee shop or restaurant, or you can invest in the equity of a tech startup where you know the founder, let's say, or it's a sector you're very interested in, and so you know a lot about. So you can invest in that equity, and you hope that it goes big. It's obviously very risky. A lot of those investments go to zero. It's highly risky asset class, investing in early stage startups, but there's an upside there. And so that means the amount of capital that we can raise is a lot larger. And so both of those challenges of the Kiva business model, how does Kiva make money, and then how do investors make money, were kind of solved by Wefunder. But it was the same mission of using crowdfunding, using democratization of capital to get more capital flow into entrepreneurs. It was just on a much larger scale. And so Kiva, the average loan was $5,000. Wefunder, the average investment that we make in a company is $500,000. And obviously that means you can have a lot bigger impact. So we've probably made about 1,000 investments into companies at Wefunder. So from a number of loans perspective, Kiva is still bigger, but the dollars that we're deploying at Wefunder are much larger. So
and the impact.
Hopefully, yeah. I say the depth of impact, I think, was maybe higher at Kiva. So we were deliberately trying to lend to low income entrepreneurs who really didn't have any other options. So the depth of impact will maybe greater at Kiva, but the breadth of impact, the dollars that we're pulling at Wefunder is a lot bigger. And as you were saying earlier, we think we're just warming up here and just getting going. And we hope over the coming years that this can turn into a very, very big thing, really valuable alternative source of capital for entrepreneurs throughout the country.
I just had this curiosity, so I'm going to totally put you on the spot here. So
I like being put on the spot.
Yeah. Any movement from those micro loan platforms like a Kiva, and they got started with something that then grew enough to become a kind of a business that would go raise capital on a Reg CF kind of platform? Any correlations? Have you seen anything like that?
Yeah, absolutely. There's a number, probably about 20 that I know of, that it started with a Kiva loan and then went on to get a larger amount of capital on Wefunder. So yeah, that's pretty common, and we hope to do that more. I actually, with my colleague Justin, who also now is at Wefunder, also previously at Kiva with me, we both of us presented to the Kiva kind of city managers just a couple of weeks ago about that very kind of graduation pathway. So I hope we can get more of those entrepreneurs kind of starting out with Kiva, graduating to larger sums of money, all through community-based funding, over the coming months and years.
Yeah. So, okay, so let's, I did a pretty good cut. I mean, I covered a little bit on crowdfunding. Anything you want to add for our audience to, sort of have a foundation of Reg CF and, that kind of thing?
I mean, I'll talk a little bit about the mechanics and then a little about the mission, I guess. So as you referenced, for 80 years, it was illegal for, middle-class Americans to invest in startups. You had to wait until a company went public on the stock market with an IPO.
Right.
And so the only people that got to invest in private companies, whether they were cool tech startups like Airbnb or Uber, or whether they were, local restaurants and coffee shops, you had to be accredited. That means you have either, $200,000 income, $300,000 household income, or $1 million of wealth, excluding your house. And basically, it's the top 5% or so of the population,
Right.
That qualify as accredited investors. And so, as you referenced, the Jobs Act of 2012, regulation crowdfunding was one component of that, rolled out in 2016. That now allowed everyone to invest in startups. Everyone in the country can invest $2,500 per year, and then you can invest more than that, depending on your income and wealth. The SEC has a formula. And so for the first time in 2016, it was legal for everyone to participate in investing in startups in their community, or again, in a sector they care about or a founder they knew. And our founders were pretty instrumental in passing that Jobs Act legislation, which went through Congress. It's remarkably bipartisan, right? Because, for Republicans, it's like making it easier for entrepreneurs to raise capital. And why the hell should the government tell, a middle-class American that they can't, they're not allowed to invest in their friend's company? That's, overly kind of restrictive. And for Democrats, like, you look at the stats around the percentage of venture capital going to women, or the percentage of venture capital going to founders of color, or the percentage of venture capital going to states outside of California, New York, and Massachusetts. They account for about 80% of venture capital today. And so, for Democrats, this is about leveling the playing field and making it easier for founders to access capital. And by the way, if you look at who VCs are, heavily concentrated on the coast, like heavily concentrated in white men. And so there's an equity angle there from the Democratic perspective. So the Jobs Act actually passed, I think it was 406 to 5, like really bipartisan support. So that's kind of the mechanics. You referenced that. And the mission is the other thing that I think is worth touching on. So for Wefunder, like I mentioned, we're a public benefit corporation as opposed to a C Corp. So we really have a mission component of what we do. And I think about it on two sides, right? So on the founder side, it's about trying to get more capital flow into founders. We believe in entrepreneurship. We think it's cool when founders take a shot at building a business and running their company. And we think it's going to be good for America. And we just expanded into the EU as well, and hopefully around the world. But we think it's good when more people are starting companies, more people are taking their shot at launching companies. So this is about getting more capital flow into founders on the founder side. And then on the investor side, again, it's why should only rich people get to benefit from the wealth that's created by the next Airbnb, the next Uber? We think it's cool when more people are participating as investors and investing in companies they love, both from a hopefully economic return perspective, but also just like, staying close to entrepreneurs, founders, following along with their stories. It's very kind of energizing. And we think a world in a society where more people are participating in startups as investors is a better world to live in.
Yes. And that's the thing, that piece you say about how missing out, because I didn't, cover it, but it is kind of part of the story that motivation for entrepreneurs to get access. But you said at the very beginning, the democratization of the capital markets, right? And it was, they looked at that technology, the drones and the smartwatches and stuff, and the companies that raised their first few $1 million to get to market through reward-based, then went on and raised venture capital or sold the company or did huge, acquisition. And all those original investors or those people, those buyers, didn't reap any benefits of that. And they could have put that same $1,000 that they bought a 3D printer in for equity and had, they're not going to have $10,000 on that, but they might have $2,000 back or $3,000 back, right? Based on the multiple of when that company went. And so why not let them do that? And that, the gap that I'm filling is, educating people on how to do that, because it is a whole new ball game, the language of it, how you review a company, it's all, and there never was any training on there. And that's, the gap I'm trying to fill.
And that's what I love about this model of regulation crowdfunding, right? And we call it community rounds. We prefer the term community round to equity crowdfunding. Our CEO has always had a bee in his bonnet about this, just like equity crowdfunding. He doesn't like the term. So he really likes community rounds. You run a friends and family round as a founder, you run an angel round, venture round, and a community round where your community gets to invest. But what I love about this community round model is, if you are interested in angel investing, you want to diversify your portfolio. So you're investing in the public stock market, you're investing in real estate, you're investing in bonds, whatever. And let's say you want to deploy a small amount of your capital to invest in private startups. Typically, as you mentioned earlier, you're writing a 10K check, a 20K check, a 30K check. I've spoken to a number of people over the last few years that, they wanted to get into startup investing. Maybe they had 50 grand or 100 grand to deploy. And so maybe that's like 2 or 3 shots on goal, right? 2 or 3 investments. That's a really small number, because a lot of this is portfolio diversification. You want to kind of spread it around, and you also want to learn lessons, because the investments you make, first of all, probably you need to learn lessons by making mistakes. And so what Wefunder and platforms like us allow you to do is break that into $500 investments or $1,000 investments. And now that same 50K can be spread around 20, 30, 50 bets, 50 shots on goal, and you're learning kind of 50 times. And then you can ramp up and increase the check size as you go. But it allows you to kind of get started with a much kind of lower barrier to entry, much less risk initially.
Absolutely. And that the part of my intro, when I talked about how angel investors in the Southeast, I don't know, you probably travel all over and talk to different, just in the course of it. But in the Southeast, I don't even know why they got stuck on this kind of a thing, but I'll go to the angel groups, because my beef with some of the angel groups, or the thing I try to help them understand, that have this sort of, they think, it's them and us, and crowdfunding investors and, us, the regular investors, is that we, like in Atlanta, okay, I'll just use Atlanta as an example, and I would guess almost every major metro, just based on the numbers on a national basis, have the same sort of thing. So on any given day, we have 30 some odd angel incubators and accelerators that are supposedly preparing companies to be capital ready. And then they come out of that, and they're supposed to go and knock on the doors of the angel investors in the community. The incubators and accelerators are not teaching them or helping them understand their options on any of the direct public offerings, Reg CF, for example, or interstate. Every state has interstate exemptions, right?
Yeah.
Hardly utilized at all. And then they and so they're all knocking on the same doors and so on any given Sunday, we have at least 100, 200 companies that have either are graduating, gone through some of this process. And we have less than 150 card-carrying angel investors in our greater Atlanta area, that are part of a group or this 100%. Kind of stuff. Right. And so, and not every investor is investing in every company. So there's just not enough capital. And, it's like, but so similarly, and I say to them, and then these angel groups are always trying to grow, get new people. And I knew from running my own angel group that when the Great Recession happened, my mistake had been that I had not been filling my bench. I had people that were, in, but then they had to go make sure their own businesses stayed healthy, and they couldn't do the time and do the stuff they needed to make. They had the money, they had the desire, but they couldn't do the due diligence, to do that. And the way our group worked, it was, investor led, due diligence, a champion kind of a model. And so, we just sort of kind of dried up. And I didn't have new people coming in. And, you know, and I realized that. And and educating people to be comfortable to write that 10K check takes a little bit of time. And so to me, the proving ground, to your point, the proving ground in a Reg CF, people getting involved in that. And whenever I pitch on this, when I do educate, you know, in-person education about the Jobs Act and economic development and, you know, engaging investors and cultivating an investor community, I always have a millennial that raises their hand and says, how do I get started in crowdfunding investing? Because they were part of that reward-based generation, and they have no issues with it, right? And so I go to these angel groups and I say, you should be offering this or partnering with me to build this in our community. So let those millennials, let those 30 somethings that are making $150,000, $200,000 a year, not ready to be a part of your angel group, encouraging them to invest in local companies with a Reg CF platform or an interstate platform, so that in 3-4 years, when they've done this a number of times, they're at a new income level, they could be an active and really good participant in your angel group. They may, you know, do 1 or 2 that way while they still continue with their portfolio of Reg CF, instead of everybody knocking on the same person's door when they hear that they sold a company and now they're flush with cash and now come be an angel investor, and they have no idea actually how to be an angel investor. And it's like, why do y'all knock on all the same people's door? Why aren't you build this new generation of entrepreneurs? Why not invest the same level of commitment in the community to build crowdfunding investors in that community? And it's just, I really struggle with getting that message across. So given all, like, so around the world, you know, where you're going now, you're starting up in the EU, you know, do you find that messaging hard, the same struggle that I have, that 1, they don't know that they can invest this way, and 2, those that are in those community already doing it, are they embracing, you know, cultivating a community of crowd-based, community-based that builds, you know, the whole ship rises when we do this? Or you know, what are you finding out there in your walks and talks and, you know, things that you're doing?
Yeah, it's a really good question. I actually have a little conviction in my answer, because I think we as a platform could be doing a lot more to build that up. Wefunder is a two-sided marketplace. Here's my kind of excuse and justification for our kind of strategy today. Wefunder is a two-sided marketplace, right? We have founders and we have investors. And like with all two-sided marketplaces, there's a real kind of network effect where the more founders we have, the better of a platform it is for investors, because investors are more likely to find an entrepreneur in their community or, you know, in a sector or a stage that fits with what they're interested in investing in. And the more investors we have, the better it is for founders, because we'll put the founder in front of more people and hopefully they can raise more capital from the Wefunder audience. And so there's definitely kind of two-sided network effects. And so we've been focused initially more so on the founder side, I would say, because what we find is we've had, you know, Substack is a newsletter platform. Many of your listeners will probably know them. They just raised on Wefunder. They raised $5 million, which is the regulation crowdfunding maximum, in a day on the platform. And almost all of that was coming from their existing users. And so for us, Wefunder, if we find an entrepreneur like that has a huge community of people that will jump at the chance to invest in that company, then if we get more founders like that and entrepreneurs like that on the platform, they bring the investor side, right? And so the focus for us has been get more really, really awesome founders on the platform, and then that takes care of the investor side, which has kind of meant that we haven't done as much investor focused recruitment, marketing, and education as hopefully we can get into over time. There have been some efforts, of course, like both on the marketing side and on the education side. So if you go to wefunder.com/school, there's some really great resources that we put together on how to think about angel investing. Our FAQs, I think, are really good. You know, there's various kind of places on the website where we're trying to educate investors. We try to do a good job of transparently communicating the risks. So highlighting this is very, very risky. A lot of these investments will go to zero. You shouldn't invest more than you can afford to lose, et cetera, et cetera.
Right.
I think we have a phrase of socially good lottery tickets. You're buying a lottery ticket when you invest in a startup, and you're having a positive social impact. So it's socially good, but it's a lottery ticket, and hopefully you win big. But many lottery tickets, are not going to be winners. So we try to do a good job of kind of setting expectations and educating investors as we go. But honestly, oftentimes, like, it's a little out of our hands, because the way that the investment flow works on Wefunder is an investor will kind of, get an email from their local brewery, and the email says, "Hey, we're raising capital. We would love our customers to become investors in our brewery. Here's the link to our Wefunder page." And the investor will then go to the page and read all the stuff on the page, and then check out and invest. And they haven't, taken a detour through the Wefunder, educational materials. And so, hopefully then over time, we can send that investor an email saying, "Hey, thanks for investing in this brewery. By the way, if you want to learn more about angel investing, here's some resources that we put together." But I definitely think we could do more as a company. And hopefully over the coming years, that kind of investor education and investor kind of focus will kind of catch up to where we've been on the founder side.
Yeah. So to that end, let's talk about sort of the nuts and bolts of how the Reg CF operates, and if it's the same with Wefunder as all of them because of the regulations. Like, for example, one of the things, like when I have advised regular tech companies raising capital from angel investors, or even with my own angels and in traditional angel type of investing, you always want to make sure that they have the ability to raise the capital that they need. So we would say, I would advise them, set up an escrow amount. It mitigates the risk that the investors feel, because if you need to raise $1 million, if you're trying to raise $1 million and you really need 350,000 in order to get to this next level of your product being out and closing revenue, then you need to set your escrow at 350, so that you have enough to be able to get through to do the thing that's going to make it easier for you to raise the rest of the money, right? And so a big safety, I guess the safety hatch that the SEC put in was within Reg CF. You had, because it was the same thing, reward-based crowdfunding, you had to raise a certain amount, a minimum amount of what your total is. And then people started sort of so if you were raising 100 grand, 25K was your minimum. And then the people would invest, and it wouldn't be released to the company unless they had raised that minimum amount, kind of a deal, at the end of their cycle. Even if they were trying to raise 100,000, the 25K was it. And so people started to game it and be like, "Oh, I'm trying to," they would try to oversell what they said their minimum amount was, and things like that, trying just to be able to get some money where they really did need more money than what it is. And then there's been this new way that when you look at a company that raises a lot of money, sometimes they actually are doing it in stages where they're getting better each time. And it would be like a normal, not really seed and Series A, but it would be sort of a process. So talk about where we are with that, what misperceptions there are, the value of this amount, and what's the best practices for a company when they know they need to raise a certain amount of money. But it's hard when you have to you don't already have a client base or community to bring in to create that awareness and push it out there, when Reg CF platforms, as far as I recall, don't actually bring investors to a company, other than their overall environment, because there's investors on there, and they get some traction, they get promoted. Here's a company that's closing, here's a company that's hot, here's a company like that. So talk a little about that dynamics of figuring out how much to raise, what's the minimum, and how companies do best practices with not gaming the system, but actually doing what it's intended to do.
Yeah, I mean, it's honestly a pretty complicated question, right? Like, how much should you raise? I was chatting to a founder yesterday, and she said, one of the downsides I've heard about raising capital through regulation crowdfunding as an entrepreneur is it's lots of work and it costs lots of money. And I told her, sometimes that is true, oftentimes that is true, but it doesn't need to be true. And it kind of depends on, let's say, how much you want to raise and where you set your goal, given kind of where you are as a company, right? So with the Substack example I gave earlier, or Mercury Bank is another example, a new kind of banking stack for startups. When SVB, Silicon Valley Bank, shut down, I think after JP Morgan, Mercury Bank was the second highest recipient of kind of inflow of funds from startups. Really great company backed by Andreessen Horowitz, raised 120 million Series B and then opened up $5 million allocation to let their customers invest in them. Not because they needed the money at all, but just because they thought it would be really, really cool if thousands of their customers had a chance to invest in them. That will make them more loyal customers, more passionate brand ambassadors. So in the case of Mercury, in the case of Substack, very large Series B companies, thousands, in Substack's case, millions of customers. And when they said, hey, do you want to invest in us? They raised $5 million in a day with, very little effort on the marketing side and $0 spent in terms of marketing the raise, right?
Wow. Okay.
Now, imagine you have a consumer packaged goods company, a food and beverage company, putting their products on the shelf in Whole Foods. Those companies, if you look at the average, they're probably averaging like $250K on Wefunder, right? For let's say a kind of seed stage Series A CPG company. So if they say, I want to raise $1 million on Wefunder, then that might be really hard work for them. So they might have to really aggressively push it, run a big marketing campaign, try reaching out to angel investors, like a lot of work from the founder, a lot of work from the marketing team, trying different strategies over multiple months, trying to get up to $1 million, right? And maybe they want to spend some money on ads because, if they spend $1 on Facebook ads, they raise, $5 of capital and also recruit a customer that might spend money with them. And so then it ends up becoming quite expensive. Whereas if they just said, you know what, I might need to raise $1 million this round, but I'm going to do 250K of it in a community round on Wefunder. And I'm going to try to raise the 750K from going to try to find an institutional investor or going to try to raise it from angel checks conventionally. And so then, the 250K is only a part of the round. Maybe then the 250K raise is quite easy for them. They don't need to spend any money on ads. It's quite quick and easy for them to get it done. So, but it's kind of like, depending on where they set their target, the community round can go from being super quick and easy. Just sent an email. I raised what I was going to raise from my customer base. Then I closed it down and got back to the run of the business, versus like a real grind. And it's a lot of work because I set a goal that was maybe a little bit too ambitious. So I think we try to guide founders in terms of okay, what's a realistic goal given the size of your audience, and trying to set their expectations on what's going to be a good amount for them to raise. And as long as you set that amount in a reasonable range and you execute well on the campaign, then hopefully it should be a relatively kind of quick and easy thing to execute on. Now, if you need to raise that $1 million and you can't raise the other 750K through whatever, finding an institutional lead, let's say, then sure, we can try to help you raise that 750K through Wefunder, but it's going to be hard. But if you tried to raise it outside of Wefunder through Regulation D, it would also be hard.
That's
so we
a
might
big
be able to
point.
make
It's always hard. It's just which hard do you want,
Exactly. Yeah. But it can be very easy if you set a goal that's reasonable and kind of within the investor demand that's in your LinkedIn network, in your Facebook network, in your friends and family, in your customer base. And so then you can actually execute on it quite quickly, get back to running the business.
Yeah. So let's get, okay. So with that, so in that example, would it make sense for a company because they know that in order to reach their target or what they want to do within the next 2 years or 3 years, let's say, with growth. And they say, okay, I believe we can do the 250. So we're going to do that. We're going to accomplish some things. And then not too long after, as soon as we have some progress that we can be like, and this is what we did, right? Then we're going to go raise that other 500 using Reg CF again. I mean, they can do multiple rounds within a period of time, right? That some people, so that might work, because then those investors that had progress there, they go, oh yeah, I put 1,000 in. They're doing more now. I like this company. They've been communicating with me. They've been telling me about this stuff. I really believe that they truly can get. Now I'm going to come in with $2,000 this time around, and I'm going to tell my friend, and he will come in with $1,000. That kind of a thing, right? Is that a common way that you see progress and success?
Yeah, absolutely. Very common for folks to do around, put that to work to grow. Then that's a larger customer base that then you can come back to raise from again. And hopefully, if you've demonstrated growth, those first investors, if you've done a good job kind of updating them on how things are going, and you show them, hey, since you last invested, here's all the progress we made. We're raising again, maybe at a slightly higher valuation. Folks can come in again. So yeah, definitely common for folks to do, multiple rounds. I think we've had one company that's done 4 rounds through Wefunder.
Yeah. Okay. So, and then is it always equity? There's different, because I've seen, or is it like Reg CF I've seen other ones that do debt, but they do a combination of rewards and equity and a debt, like a convertible note? Talk about the structure and the variety of ways that companies attract investors or offer up their offer.
Yeah, so equity is definitely the most common offering on the Wefunder platform, and there's kind of 3 main varieties of equity. There's a price round, which is probably the most clear cut, which is where you just put a price on the business, a price per share, and if the business is valued at $10 million and the investors are investing $1 million, they have 10% of the company, right? And then you have convertible notes and safes, both of which are examples of what's called convertible equity. So that's where it isn't technically equity when the investor invests. It converts to equity in the event of a future financing round or the exit of the business. Those tend to be a better fit for earlier stage companies, because to do a price round, you have a lawyer write a subscription agreement, investment contract, which is like 70 pages long, and lots of money in legal fees and lots of kind of clauses in the contract. And so for early stage companies, Y Combinator, which is widely regarded as the best accelerator in the world, Wefunder actually went through Y Combinator in 2013. They popularized this instrument, the SAFE, simple agreement for future equity, it stands for. And so with a SAFE, that tends to be a better fit for earlier stage companies, because there's only 3 pages of the contract. There's a lot less clauses, and you kind of defer the formal valuation of the company until usually a venture capital led follow-on financing round in the future. But anyway, so safes and convertible notes and price round, kind of 3 variants of equity. Equity probably accounts for 90% of the investment volume on Wefunder, but then the last 10% will be for debt. And so there are loan offerings on Wefunder, either a loan with a fixed interest rate, which is the common loan that we all know, you're going to pay back this loan with a 10% interest rate over 5 years or whatever it is. And increasingly common, I think we have what's called revenue-based financing, or revenue share loans.
Oh, that is great to hear. I'm a big fan of that for growth companies.
Yeah, we like revenue-based financing. And so it's, you pay a multiple back to investors. Maybe it's 2x. So let's say the company borrows 200 grand. That means they're going to pay investors back 400 grand. So as an investor, you double your money. And the timeline that you get paid back on is variable. Usually it's a percentage of the revenues of the company. Maybe it's 5% of the revenues of the company. So if in year 1, the company makes, $500,000 of revenue, they take 5% of that, 25K. Now they've paid off 25K of the 400K they owe. And we like our revenue-based financing. It kind of aligns the cash flows of the business with the repayments on the loan, which is kind of what you want as an entrepreneur. It aligns the incentives of the entrepreneur and the investor, because the faster the business grows, then the revenues go up. That means the repayments go up. That means the loan is paid off faster, which is better for investors. So, but the entrepreneur is also happy because, the revenues are going up. So we really like revenue-based financing. My colleague Justin, who I mentioned earlier, he's really leading the charge on getting more and more revenue-based financing deals up on Wefunder.
Okay, so a couple of things I want to follow up on that. So when you talked about traditional, equity, right, and then the convertible and safe, and that, and you in the traditional, you talked about really kind of like what it sounds like a private placement memorandum would be with these large documents. Are they still coming up with those kind of PPMs when it's a equity based Reg CF offering, or I thought it was simplified a little bit?
Something similar, yeah. So when you launch a regulation crowdfunding offering, you need to file what's called a Form C with the SEC. And so our team has built software. So we'll kind of help you file kind of TurboTax style software that will basically we'll do the Form C filing with the SEC for you as a founder. And then as an investor, you can look through that Form C, and it has financials of the business. It's an SEC requirement that because there are retail investors investing, there need to be, financials. And if you're raising more than a certain amount, they need to be reviewed, audited by an independent CPA. So you can be confident as an investor in the financials that are being shared with you. And then you can see the investor pitch deck. You can watch the video. You can connect with the founder on LinkedIn. You can ask a question on the Wefunder platform. So there's lots of different ways that you can kind of get information about the business and kind of connect with the founder before deciding whether to invest. And certainly the Form C, which is kind of similar to a PPM, is one of those kind of data sources.
Okay, so a tool helps to kind of generate that. They don't need to go off and pay 20 grand to a lawyer, and then
most founders are paying no legal fees to run a campaign on Wefunder. If they want to have a lawyer draft a custom investment contract, then and that's like the price round, that there would be a fee there. But if you're just using a safe or a convertible note or the revenue share loan contract that we have, those are off-the-shelf Wefunder contracts, so that hundreds of companies have used, so that you can just use them and save on legal fees.
Okay, so that's and okay, so let's talk about, you have to go through the SEC really sort of or FINRA actually, right? FINRA has this oversight on Reg CF, the same that they do with broker dealers, and you have to go. So to those investors that are listening out there, one of the pluses of investing through a Reg CF platform versus the hodgepodge of interstate or Reg A plus is that there is there's a bar of who is reviewing the companies and putting them out there, and the companies have to go through a serious screening, right? Because you have to validate them that there's not fraud or potential fraud. They have potential to go through. So it's like the similar screening in my mind, and how I describe it, it is as good as or better than what a screening committee of a traditional angel group would take a company through because of the level of oversight.
I might push back on that a little bit, actually. In some senses, I think you can argue that. But so there's kind of two main things I'd focus on in terms of the screening or the underwriting due diligence. The first is, as you say, kind of fraud checks. So there is a lot of requirements from FINRA around kind of fraud and compliance checks. That's kind of like, black and white, kind of fraud compliance checks. The second one would be the financials. So there are higher requirements. The FTC says because of the fact that there's retail investors in this deal, there are higher requirements in terms of those financials being available. And, if you're raising more than 1.235 million, those financials need to be audited by a CPA. And so you can be confident in those financials that you're looking at. What I would say we don't really claim to do at Wefunder is to say, this is a good investment. right? And I would definitely not say, every investment on Wefunder, Jonny would say is a great investment and is like definitely going to make you money, right? We see ourselves as kind of an open platform. So there's the black and white kind of fraud compliance checks. There's confidence that the financials you're looking at have been approved by a CPA. But then beyond that, like whether or not you should invest in that company, whether this is a good business model, whether it's a good valuation. I mean, within reason, if a company is trying to raise on a crazy valuation, I would say I've seen some companies with our competitors, and you look at the valuation, it's like that is absolutely insane. And we actually multiple times have said no, and then seen a company end up on one of our competitor platforms raising on an insane valuation. So within reason, but I think kind of, I would say, a lot of the companies that you see raising on Wefunder, let's say, wouldn't pass through and wouldn't kind of, get investments from an angel group because that angel group might not decide to invest based on their own interpretation of, whether this is a good business model or not. Yeah. So I just want to be super clear that we see it kind of as an open platform.
Yeah, I was thinking more of like because of the oversight of FINRA and having to do that the background check, the black and white, the audited financials. A lot of companies that come through at a seed stage to angel groups, they don't have audited financials, and the angel groups don't do until they get through all the way to due diligence. They don't, do any of that preliminary type of screening. They just look at business model and valuation and those kind of things, as part of it, and the structure and the terms of the PPM and the team, which are the subjective factors that, as you say, somebody that's looking to invest on the platform would have to go through. And that's the kind of stuff that I teach in the course, is how do you assess that? How do you judge those things? Because that's the more you have to do the, so I like to rely on the fact that,
and that's the hard
CF
work.
is right. That's the stuff. And do they really understand their marketplace to know how they're going to put money in the register is a discernment, versus the black and white of what you talked about, right? But I wanted to have established that there is a comfort level when, at least it's not a pure lottery ticket, because I'm always trying to fight the perception that angel investing or investing in entrepreneurs is like gambling, right? Is that,
that's true.
There's not a pure lottery ticket, because there is you have a lot of
information. You have a lot of information. And the interesting thing about the private markets, right, is you can have an edge in terms of information that it's not legal to have in the public markets. So yeah.
Okay, so when you're going back in, how companies attract investors, right? So they have to, I have this, and I won't go into all I have this, what I call a Cougar theory of private equity, and to the difficulties it takes for raising traditionally under angel platforms and angel investors versus like the Reg CF or any kind of direct public offering kind of a deal, crowdsourced. I explain and all of them are hard, and all of them take longer than you think, and all of them take more investors than you think to do it, right? So the theory that I developed over a decade of running my angel group, and the companies that were successful, weren't successful, their processes, things like that. For every check writer you're going to have what I call sweethearts. 3 times that are people that you have to answer questions and spend time, in a traditional model before they make a buying decision. And then to get to that number, it's an order of 5x on top of that. It's 15, 3 times 5, of who has to see it in order to, come to a point of saying, yes, I want more information and answer these questions for me. And so if you're raising $1 million under a traditional model, and the people of the average of accredited investor and accredited group of an angel investor group is 25K. So that means you have to have 40 check writers. So you're going to have conversations with 120 investors answering questions. And then you need to have a plan to put 600 investors into your funnel. pitch events, virtual pitch events, outreach, whatever, more than just a text or a message. Oh, I got this deal. It's actually looking at a one pager or seeing a video or something like that. And I said, when you go to any kind of, we haven't done the numbers, but just on the models of what it takes in a sales funnel with selling online, what's the order of eyeballs in addition to getting them to, look at your materials. And so, that's the unknown to me in a direct public offering of a kind of a crowdfunding platform, and part of that, figuring out what's the right amount, because, and this has been sort of in a way, I guess a criticism of most Reg CF platforms is that I'm having to drive my traffic, right? But then once I'm in there, my investor, I don't necessarily know, my potential investor, did they, because they fill out their thing, they're looking, they want to, then they go and they look at other companies, and I don't necessarily have that relationship if I'm doing advertising or doing stuff and I haven't directly sent them to it to say, and then follow up, did you go? Because there's not a tracking mechanism. So correct me, please. Well, how does Wefunder do that? Do they get to know when an investor that they've invited looked at it? Is there a crossover where your pool of investors, at what point does your pool of investors get to see a deal? Is it because they've preference, I like consumer products, so when another consumer product comes on the platform, I might get an invite to look at them because I'm on your email distribution list? So talk about sort of that challenge of the funnels and owning the relationship if I'm driving traffic and I benefit from that, but then also benefiting from the overall community of who's an active investor or an investor on your platform.
Yeah, absolutely. And then I do need to go, unfortunately. I'm leading a meeting, so I'm running late for that. But
I'm sorry.
No worries, no worries. Yeah, so you can, I like how you frame that, which is, I think, one of the misconceptions that founders have is, oh, what's Wefunder going to do for me? How are you going to raise me the money? And what we found historically is that the majority of the money will come from people the founder brings, right? Whether that's angel investors writing larger checks, friends and family, their customers, their community, their own marketing on LinkedIn or what have you. And so one of my main jobs usually is kind of recalibrating expectations and saying, actually, no, sorry, you'll get some money from our investor base for sure, but you got to drive it. And if you can't do that, it's probably not going to work. In terms of how we raise the money from our investor base, as you say, we have 1.5 million people on our email list now, registered users. Of those, I think 300,000 have made an investment on the platform. And so we have a weekly email that goes to all of those investors that highlights new companies, closing soon companies that raised the most money last week, in kind of a list of companies. And then we'll do dedicated marketing emails where, as you say, if you're an investor that's told us you like investing in CPG companies in Georgia, if we have a CPG company in Georgia that launches, well, we want to put that in front of you because you've told us you want to see that deal flow. And so we're helping you to see deal flow. And you can add kind of stipulations in terms of this stage and this, revenue threshold. And we want to get more and more sophisticated over time and use AI to kind of match, investment opportunities to investors along the same lines of what investors have told us they want to invest in. So we're trying to get better and better at smartly marketing so that founders can raise more and more capital from our investor base. And like I was saying earlier, the bigger we get as a platform, the more valuable our investor base is going to be. And the more data we have in terms of how investors behave and, what categories they're interested in, geographies they're interested in, the smarter we'll be able to be in terms of matching founders and investors. So, but yeah, at the moment, and probably forevermore, the percentage of the raise that is coming from the Wefunder investor base averages about 1/3, 30%, 1/3 historically.
Okay.
So it's a minority of the total investment raise.
They have to own their opportunity. So thank you so much for coming out. Everybody go to wefunder.com. They've got great tools. They will help you if you are looking at that, look at, raising capital or investing. And the rest of the links are in the show notes to connect up with Jonny. And thank you for taking the time out. I apologize for making you late. I could just keep
No
talking
worries.
about
I'm
this
sorry you
stuff
have to run.
forever.
I would love to. I would love to talk for longer. It's a really awesome conversation. Most of my job is focused on the founder side, so I really appreciate the focus on the investor side and all your great work to try to educate people about the opportunity to invest in, private companies and startups, and also how best to do that and how to think about that. So yeah, hope to stay in touch and do more together as we both try to increase the number of people who are participating as angel investors here.
Yeah, absolutely. And as we get the education going, then it may be something that works well for you guys as well to incorporate or something. So we're in this together, and we're both very committed to growing the community of entrepreneurs and investors, through crowdfunding and direct public offerings. So yes, Jonny, we will stay in touch. Thank you so
Love
much.
it.
Onwards and upwards.